Welcome to Global Experts Network Learning Platform. I am delighted to start Module 4 of our Investment Analysis course, where we will explore risk analysis and portfolio theory. In this session, we will bridge the gap between simple returns and the complex reality of market uncertainty. In this module, we have a comprehensive agenda. We'll begin with the fundamentals of investment risk, looking at volatility and beta. Then, we'll move into portfolio theory, exploring the power of diversification and the efficient frontier. Finally, we'll master the capital asset pricing model and its real-world applications. Before we dive into the formulas, we must ask, what is risk? In finance, it's not just the possibility of loss. It's the probability that your actual returns will deviate from your expectations. It is the fundamental price of potential reward. Risk is not inherently bad. It's the engine of return. We measure it statistically using variance, standard deviation, and beta. Remember, in efficient markets, there is no free lunch. Excess returns require accepting excess risk. This trade-off is the core of every investment decision you will make. To build a resilient portfolio, we must distinguish between the two primary types of investment risk, systematic and unsystematic. Understanding the difference is the first step toward effective risk management. Systematic risk, or market risk, affects everyone. Think recessions or interest rate changes. It cannot be diversified away. Unsystematic risk, however, is specific to a company or industry, like a product recall. The good news is that this risk can be nearly eliminated through the power of diversification. Now that we understand the types of risk, how do we quantify them? We start with standard deviation, which measures the total variability of an asset's returns over time. The formula for sigma calculates the squared deviations from the mean. A stock with a low sigma, say 8%, moves in a narrow range and is suitable for conservative investors. Conversely, a high sigma of 35% indicates high volatility and the potential for larger gains or losses. While standard deviation looks at total risk, beta measures how an asset moves relative to the overall market. It's our primary measure of systematic risk sensitivity. A beta of 1 means the asset moves in lockstep with the market. Aggressive assets have a beta greater than 1, amplifying market moves. Defensive assets have a beta between 0 and 1, while inverse assets, like some gold ETFs, move opposite to the market, acting as a natural hedge. The most important tool for any investor is diversification. It's the practice of spreading investments across different assets to reduce exposure to any single economic event. Without diversification, you are exposed to full, unsystematic risk. One bad event can lead to large losses. By spreading across 20 or more assets, you nearly eliminate that risk, smoothing your returns over time and reducing anxiety. It is rigorous mathematics applied to common sense. The secret ingredient to diversification is correlation. It measures how two assets move together, ranging from perfect positive to perfect negative. Assets with a correlation of +1 move in lockstep, offering zero diversification benefit. The real magic happens when we find assets with 0 or negative correlation. A perfect negative correlation of -1 could theoretically reduce portfolio risk to 0. This is why we seek uncorrelated assets. This leads us to the heart of modern portfolio theory, the efficient frontier. It's a graphical representation of portfolios that maximize return for a given level of risk. On the frontier, portfolios are optimal. Anything below the frontier is suboptimal, as you could achieve a better return for the same risk. We also identify the minimum variance portfolio, or MVP, which represents the lowest possible risk achievable through the current asset mix. Now, we move to the capital asset pricing model, or CAPM. It's the foundation of modern asset pricing, allowing us to calculate the required return for any risky asset. The formula is simple but profound. Expected return equals the risk-free rate plus beta times the market risk premium. This model prices the systematic risk you are taking. It was developed in the 60s and earned its creators a Nobel Prize in economics. We can visualize CAPM using the security market line, or SML. It plots the expected return against beta, helping us identify overvalued and undervalued securities. Assets above the SML are undervalued. They offer more return than the model demands, creating a buy signal. Assets below are overvalued. We use the term alpha to describe the actual return minus the expected return. A positive alpha indicates outperformance relative to the risk taken. As powerful as CAPM is, it has limitations. Real-world returns often have fat tails, and beta isn't always stable. This is why we also explore multi-factor models. Multi-factor models, like the FAMA French 3-factor or Carhart 4-factor models, add variables like company size, value, and momentum. These factors help us better explain the variation in stock returns and build more robust investment strategies for our clients. In this module, we've mastered the building blocks of risk and portfolio construction. From standard deviation to the efficient frontier, you now have the tools to analyze any investment with professional rigor. Thank you for joining us today on Global Experts Network. I hope you found this exploration of risk analysis and portfolio theory valuable for your professional journey. Please subscribe to the SNB Experts YouTube channel for more advanced insights and updates. Goodbye for now, and I will see you in Module 5.